outperformance of 14% for the quarter, and so year to date that brings the fund to roughly 17%. That represents an outperformance quarter to date of 6%, and year to date we are 15% ahead of the global benchmark, and that outperformance has occurred in a relatively steady fashion on a trend line. And the relative outperformance has been driven by stock selection for the most part. And three companies that stood out for the quarter were Tesla, that gained by 100%, and AMD as well as UPS, which both gained more than 50%. UPS is a leader in global parcel delivery that we know from the brown trucks on the streets. They are pursuing innovations in 3D printing which can dematerialize certain stocks of parts, which makes warehouse inventory as well as design and delivery more efficient. So UPS can 3D print engineering parts, architectural models, cables, and other items on demand, which is quite interesting and very innovative. Yeah, so with the 2-year anniversary on the 1st of October of this year, we also reached an important milestone of exceeding 30 million AUM in the fund. The performance over this 2-year period was roughly 35% on a gross basis, and that represents an outperformance of global equities of more than 20%. We're glad to see that the bulk of the outperformance is attributable to stock selection. Nearly all sectors contributed positively, and the same can be said if we slice and dice the universe by regions or market caps, where in all of these different buckets our methodology was able to generate value in a like-for-like comparison. So, for instance, the profit margin in the Singularity Fund is 12% compared to 6% for global equities. Growth rates, revenue growth rates, and EBITDA growth rates are growing twice as fast as is the case for global equities. I think it's also worth noting that in the second quarter, which bore the brunt of the coronavirus sell-off, the companies in the Singularity Fund were able to maintain revenue levels and increase earnings by 20% on a year-on-year basis, giving testament to the robustness of the strategy. It turns out that our portfolio was very resilient in a scenario such as we've seen with the coronavirus shutdown. So no doubt valuations have been increasing, but I think valuations always have to be seen in the broader context of markets. For instance, the 10-year Treasury yield was trading at 0.68% at the end of September, and that corresponds to a PE ratio of 127 if you take the inverse of the yield. Now, against this context, are stocks expensive or not? I think interest rates are to investing what gravity is to Earth. And so if you invest in a portfolio that is able to sustainably grow its earnings, that PE ratio in the context of a low yield environment can go a lot higher, especially if the growth rate exceeds the risk-free rate and the equity risk premium, at which point valuations become undefined or singular for that matter. Now, valuations aren't going to grow into the sky, but I think it does mean that a higher PE ratio is justified in this context, and that we can't just compare the current valuation levels to the history of the last 10 or 20 years. So in that context, the Singularity portfolio kind of defies some of the assumptions made in traditional valuation models and could be even cheaper than the PE ratio suggests.